Hello everyone, today we're going to be talking about time, SMT, change in state of delivery. This is going to be our second episode in the model series, where by the end you're going to have an 80% win rate model that you can utilise in your trading. So guys, these are the topics that I'll be going over today. Firstly, I'll be clearing up time cycles. Secondly, I'll be talking about macros. Thirdly, I'll be talking about SMT. And finally, I'll be talking about change in state of delivery. If you guys don't have a clear understanding of these four things, you really need to start listening, because this lecture is absolutely crucial in the model series. So guys, as I said earlier, the first thing that we'll be covering is time cycles. I had a few questions and a few people were a bit confused about my last lecture on time cycles, so I just want to clear everything up and show you how precise they really are. So as you can see on my chart, the big coloured boxes, these are my 90-minute cycles, the blue, the red and the green. If you look inside of the blue boxes, you can see these grey ones. These are my 30-minute cycles. Now, don't think that the only two time cycles that you can use are 30-minute and 90-minute. No, you can fractalize these up and down. You can keep dividing these by 3. You can turn these into 10-minute cycles, and you can even fractalize it even further down if you really are that crazy into 3-minute cycles, just like this. If you want to pay attention to the exact minute that highs and lows form, this is what you can do. You can fractalize time cycles into 3-minute cycles. With this, you can get immense levels of precision, and you can trade on the micro time frames, such as the 5 and 15 second, to continue to trade with precision and accuracy. Moving on from that, the first thing I want you to look at is the grey boxes, these two in particular. As you can see, after this time cycle closed, this new grey box opened. This is our 4 o'clock open on our time cycle. What I want you to look at is, as soon as 4 o'clock opens, we sweep the last 30-minute cycles high. Now, why is this of any importance? As I mentioned in my previous time cycle lecture, if you wanted to see continuation to the upside, we would have displaced above this high and began to use this candle as support on price. However, as you can see in this example right here, we came just above this 30-minute cycle high and never even closed above it. This is a very strong warning sign that we could start seeing a reversal. The confirmation for this reversal would be the close below this candle right here. I'll go over why this candle is important later on in the video, but as you can see, as soon as we closed below and retested this one candle, we continued lower. Now, what do we use as our drawn liquidity? Equilibrium of the range. Now, you might be saying, why is the equilibrium of the 30-minute cycles range important? Well, price reaches to equilibrium 90% of the time. I don't know about you guys, but 90% sounds pretty nice to me. Now, you can get greedy and focus the opposite side of the 30-minute range. However, this only has around a 70% chance of hitting. So my recommendations would be take a fat partial on equilibrium, because as you can see, we failed to displace below equilibrium and continue to use it as resistance and price. If we saw price displace below equilibrium, retest it and reject off it and continue to use it as resistance, we could then be focusing opposite side of the range. Now let's go on to our next example. As you can see, this is our 30-minute cycle that we'll be paying attention to. When our next time cycle opens, as we can see, we take out the last 30-minute cycles low. I might be saying, why is this of any importance? Well, as you can see, we never even closed below this low. If we wanted to see continuation to the downside, we would need to displace below this low and see it acting as resistance on price. As you can see, we failed to displace below, so this would be our first warning sign that we could start seeing a reversal. Now, what do we target? Same things before. We target equilibrium of the range. This has a 90% chance of getting hit. However, in this example, unlike the other one, we started to use equilibrium as support. As you can see, price failed to displace below equilibrium multiple times. This is a strong indicator that we could start seeing higher prices, and we could start to see this 30-minute cycle high get took out. I want to draw you guys' attention to the 90-minute cycles. As you can see, we displaced above this 90-minute cycle's high. Now what's interesting, if you draw this candle out in time, look at how this candle is now acting as support on price all the way out here. This is a strong warning sign that we could start seeing higher prices again. This one candle shows that we are likely to see continuation. As you can see, as soon as we close above this one specific candle right here and retest it, and we start using this candle as support, this is our confirmation that we are going to continue to see high prices. Now what do we target? As I mentioned in my previous time cycle lecture, we can use a previous time cycle, the time cycle prior to that, and the time cycle even prior to that. As you can see over here, this 90-minute cycle was our drawn liquidity. I might be saying, okay, but this target wasn't even hit. Well, the reason why this wasn't hit was because of SMT, and I'll go deeper into that later on in my lecture. But one thing I have to say, paying attention to highly correlated markets is very important, because if you weren't paying attention to a correlated market at this time, you would have not took profits and the target would not have been hit. And this is exactly why SMT is so important. And moving on to our next example of continuation. As you can see, this is how we use both 30-minute and 90-minute cycles together. If we draw out this one specific candle that made this 30-minute cycle's low and draw out in time after it got displaced through, we will need to see this continue to act as resistance on price to continue to see low prices. As you can see here, this one very specific candle was never displaced above. This is how we can anticipate that we are going to continue to see low prices. As soon as 8:30 opens, we instantly run lower, displacing below this old 90-minute cycle's low. If we draw out this candle in time, look at how it's used as resistance on price. This is how accurate this is, guys. It's so simple and it's so easy to gauge order flow off 90-minute cycles. All it is if a time cycle's high or low gets taken out and that high or low fails to act as support and resistance on price, we are anticipating reversal. If it continues to act as support or resistance on price, then it would be safe to assume that we are going to see continuation in the marketplace. Alright guys, as I said, what we're going to be going over now is macros. What macros are specific time windows, and inside of those time windows, you're looking for very specific things to happen within them. Macros do one of two things. They either form highs or lows, or they frame expansions. As you can see at the bottom of the screen, you can see these orange boxes. This indicator marks out my macro times. I'll leave the link for the indicator in the description below. Our macro window is XX45 to XX15. Inside of this macro window, we're looking for very specific things to happen to frame a high probability setup. As you can see, the high was formed inside of our macro window. Now this is not a coincidence. If I pull up the ES chart, as you can see, this high was taken out in ES. However, NQ failed to take out this high. Now because this SMT formed during our macro time, this was a high probability setup, even though we left these highs. And why would you feel comfortable leaving these highs, even if price is so close to that? Because of the time that this high was formed, SMT on the highs, and the change in state of delivery, which I'll go over later on in the video. Inside of our macro window, this is exactly what we're looking for. We need SMT, a liquidity sweep, and a change in state of delivery. This frames a super high probability setup. Just taking a trade of this breaker is a super high probability trade. Now that a swing point has already been formed, what are we anticipating our next macro to do? As I said earlier, macros do one of two things. Either form swing points or they expand. So now that our high is already formed, what are we anticipating our next macro to do? Expand. As we can see, for the first half of our macro, we were consolidating. However, as soon as our next hour opens, we manipulate up. For the second half of our macro, we expand. Same with this one. Macro engineers sell side liquidity under all these lows, and it makes us run higher into this SIBI right here. Once price fails to displace above this SIBI and starts displacing back down to the downside, this is where we can anticipate another expansion down. If we link back to the time cycle portion of this video, and we utilize this logic, look at what's happening. We displace below this time cycle's low, and look what's happening. We're utilizing this candle as resistance on price. This is not a coincidence. As soon as we displace below and start seeing this candle utilized as resistance on price, we can be anticipating even lower prices. Now our next macro. This macro engineers this low down here, and look at how much sell side liquidity is formed during this macro. This is all set up to get swept during our next macro. As you can see, our next macro opens up, runs higher, and expands to the downside. As you can tell, macros are super reliable, and for any high probability setup to form, you need it to form inside of this macro time. If it forms outside, it is not a high probability setup. As you can see over here, our low of the day was formed during our macro. Again, this is not a coincidence. The algorithm runs on time, and it refers back to these macros to tell it when to create lows, highs, and when to engineer liquidity and when to expand. And I think that'll be all for the macro portion of this video. Now let's talk about SMT. As you can see, I've drawn out all the types of SMT that you can be utilizing in your trading. For our first example, this is the type of SMT that everybody knows. This is a cracking correlation between two markets where one asset makes a higher high where the other makes a lower high, or one asset makes a lower low where the other one makes a higher low. Secondly, we got PD array SMT. As you can see, I've drawn out a BISI that has been made during an expansion leg. On NQ, price retraced back into this PD array. However, if you look at ES, it failed to do so. This is also a cracking correlation between two markets. This SMT is called candle to candle SMT. Some people call it CC SMT, it's up to you. All this is after one candle closes and the next one opens, this new candle takes out the old candle's high. However, the other asset fails to do so. As you can see here, NQ took out the latest candle's high, however ES failed to do so. This is candle to candle SMT. I would recommend using this type of SMT on higher time frames, as it's not too useful on the lower time frames. Here we have opening time SMT. Let's say this red line here is an opening time. Could be 9:30, could be our hourly open, could be 30-minute open. It could be any sort of opening price that you would like. If one asset trades up and then back down underneath this opening time, however, the other highly correlated asset fails to trade below this, this is also a cracking correlation in the marketplace, and you might need to start being wary of a reversal taking place. Down here, we've got time SMT. If you look at these two schematics that I've drawn out for you, look at when this high got formed. This high got formed one candle later than this high did. This is also a cracking correlation. Not many people know about this type of SMT, although it is very useful. Now let's move on to what SMT really means and how you can utilize it. Inside of one of ICT's lectures, he was talking about SMT, and he said SMT could stand for Smart Money Tool, Smart Money Technique, but then he also said it could stand for Smart Money Time. This makes total sense because when the time is right, a low will form and the real SMT will form with it. I will play that portion of the lecture for you now.
I'm looking for markets that are expected to go higher. Then I'm watching price trade in areas where I'm expecting things to occur anyway, the imbalance or an order block, which there is no order block in here. So the imbalance it trades down into, then it fails to make a lower low when euro dollar makes a higher high. That is a cracking correlation. That is my SMT diversion, Smart Money Technique or Smart Money Tool. Like I said, I've never really settled on what the T stands for. It's been interchangeably used for tool or technique. But I guess it really could be Smart Money Timing. You know, I guess you can add a third thing there to really confuse you. Oh, ICT, so diabolical.
So now let's talk about how you can utilize SMT real time while you're trading. As you can see on ES, we took out London's high. However, on NQ, we failed to do so. This is our first SMT. This is also SMT on a higher time frame. So this SMT is much stronger than if it was just on a 1 minute chart. Next, we've also got SMT on the highs right here. If you take a look at ES, this high was never taken. However, on NQ, this high was taken. Because this SMT was formed in our macro time, this is a very high probability SMT. This SMT should hold, and it should not get traded above. Once our real SMT has occurred, this means that manipulation is over, and the high that SMT formed on should not be taken out. If the high with a real SMT is taken out, you should be expecting a continuation. Lastly, because this high got taken out on NQ but not on ES, look at what time the high formed. On ES it formed at 7:56. However, on NQ it formed at 7:59. This is also a time SMT. Look at all the SMTs just in this one portion of price action. This is what formed a high probability setup to form. These highs should not be taken out anymore. If you zoom in, SMT forms on every high and every low. You might not see it as soon as you start looking for it, but believe me, at every single swing low and every single swing high, SMT is present. And it has to be present because SMT means that our manipulation phase is over and we are starting our distribution phase. Now for our next example, we'll take a look at what forms high probability SMTs. As we can see here, NQ failed to take out this high. However, if we take a look over at ES, look at this. ES took out our 90-minute cycle high. When SMT occurs at time-based liquidity pools, these are super high probability SMTs. These SMTs should not be taken out, and if you get a change in state of delivery after an SMT like this occurs, expect continuation, because this is a super high probability sign that we are going to continue to see a continuation in the same direction. For the final part of this lecture, we're going to be talking about change in state of delivery. So what a change in state of delivery is, it's when a sell program turns into a buy program, or a buy program turns into a sell program. So firstly, as we can see here on the left side of the curve, we have formed a SIBI. Inside of this SIBI, you can see this long wick and the high got formed inside of this SIBI. This high is now an intermediate term high. Any high that gets formed inside of a SIBI is an intermediate term high. Any low that gets formed inside of a BISI is an intermediate term low. These highs should not get displaced above. As you can see here, after this high got formed, we carried on down and we swept liquidity below this low. After the low that got formed at 3:30, we carried on up. And what I want you to look at is where this BISI got formed. As you can see, this BISI got formed in the expansion leg up from after we swept liquidity down here. And why is this of any importance? Because this BISI led to a closure above this high. As I said before, these highs should not get closed or displaced above. This simple pattern right here is our market structure shift pattern. Once we see this, we know that we have turned from a sell program into a buy program, or a buy program into a sell program. So let me go over it again. What you want to see is an expansion leg down, a SIBI get formed, and a high to be formed inside of that SIBI. After this high gets formed, we want to see one last sweep of liquidity, and then an expansion leg up. Inside of this expansion leg, we want to see a BISI get formed. This BISI signifies to us that the market really wants to rip higher, and it doesn't have time to rebalance these gaps. And after this BISI gets formed, we want to see closure above this high. That sequence of events is our market structure shift pattern. If you see this, you should know that we are switching from a sell program into a buy program. Now let's look at an example where we switch from a buy program into a sell program. This example is the example I was using earlier when I was showing you SMT, but just on the 15-second chart. As you can see here, this low got formed inside of this BISI right here. What I want you to see is that after this BISI got formed, we swept buy side one last time. Now, after this buy side got swept, look at what happened. We displaced down. And what's interesting about this is look at where this SIBI got formed. It got formed perfectly inside of this BISI. Now, why is this of any importance? This is now a BPR. Anytime we trade into this is a very high probability that we will reject off of this BPR. So a little tip, If you see a retracement into a BPR that got formed during this market structure shift pattern, this is a high probability setup, because BPRs should not get traded above. And then as you can see, after we trade back into this BPR, we continued to trade lower. This pattern right here forms every single time a reversal takes place. So if you see this happen at points of interest inside of your time of interest, then you should start getting weary, because a reversal could be on our hands. With that, guys, that should wrap up this video. If you want 80% off Apex evals, look at my bio, and all the indicators that I use will be linked in the description of this video. So with that said, I hope everyone watching has a great rest of the day. Goodbye.